Have you ever had that feeling that something just isn't right? You look at the headlines, you listen to the news, and the stories don't quite add up. One day, we are told the economy is strong, and the next, we hear about massive job losses that seem to appear out of nowhere. This isn't just a feeling, it's a reality unfolding right before our eyes. The economic signals are flashing bright red, warning us that the foundation we once thought was solid is now shaking. We are living in a time of great economic change, where the old rules no longer seem to apply, and understanding what is happening is the first step toward protecting yourself from the fallout that is to come. The numbers don't lie, even when the politicians try to spin them. Recently, the United States Bureau of Labor Statistics made a shocking announcement. They had to revise their job numbers, effectively erasing nearly 1 million jobs that they previously claimed had been created. This wasn't a small clerical error, it was a massive miscalculation. That revealed the American economy is on far shakier ground than most people believed. It's like a company reporting record profits, only to later admit their sales were a fraction of what they claimed. When the bedrock statistics that governments use to measure economic health are this unreliable, it tells you that the official narrative is dangerously out of touch with reality on the ground. This isn't just a numbers game played by economists and analysts in ivory towers. These revisions and shaky statistics have real-world consequences for everyone. When governments believe the economy is stronger than it is, they make poor decisions. They might raise taxes, or cut spending at the worst possible time, further weakening an already fragile system. For ordinary people, it creates a fog of uncertainty. How can you plan for your future, save for retirement, or even manage your monthly budget when you can't trust the basic information you're being given about the health of the economy? The confusion is deliberate. It allows those in power to avoid accountability while the problems get worse. The story doesn't end with jobs. Across the ocean in Europe, the political foundations are cracking under the strain of immense debt and social unrest. In France, the European Union's second-largest economy, the government recently collapsed, unable to manage its own budget. This is not just a French problem, it's a preview of what happens when countries spend more than they earn for decades. The political instability is a direct result of economic failure. When governments can no longer deliver on their promises, the people become angry and desperate for change, leading to chaos. These events are not isolated incidents, they are symptoms of a much deeper global disease that is now reaching a critical stage. The recent news of nearly 1 million jobs vanishing from official United States records is more than just an embarrassing statistical correction. It's a blaring alarm bell. For months, you've been told that the job market is booming, a sign of a resilient economy. Yet, behind the curtain, the reality was far different. This massive downward revision confirms what many of us have suspected all along. The true state of the economy is much weaker than the official story. If you feel like your paycheck doesn't stretch as far as it used to, you are not imagining things. This is the reality of inflation. It's a monster slowly eating away at your wealth. A slowing economy plus rising political instability creates the perfect breeding ground for that monster. When economies are weak, as shown by recent job losses, governments and central banks typically try to stimulate them. That often means printing more money. They hope new cash will encourage spending and restart growth, but that can be like pouring gasoline on a fire. This brings us to stagflation. Stagflation equals stagnant economy, slow or no growth, high inflation, rising prices. Normally inflation comes from a booming economy. Stagflation gives you the worst of both: recession pain, job insecurity, falling wages, and rising costs for groceries and gasoline. Central banks are trapped: raise rates and crash the weak economy, or print money and make inflation worse. Why are prices rising as the economy slows? Because it's supply and demand for money. When a central bank prints trillions and injects them into the system, each dollar's value falls. More money chasing the same goods means sellers can, and must, charge more. At the same time, global political chaos disrupts supply chains. Conflicts and tighter borders make production and transport more expensive. More money in the system and fewer goods available equals persistent, painful inflation. This isn't temporary, it's a structural shift. Decades of low inflation are over. Central banks like the Federal Reserve in the United States or the European Central Bank have a dirty little secret they don't want you to know. Their primary mission, they claim, is to maintain price stability and keep inflation low, typically around 2%. However, in today's world of unprecedented government debt, that mission has been quietly pushed aside. Their new, unspoken objective is to help governments manage their colossal debt burdens. And the easiest, most politically convenient way to do this is to let inflation run much higher than their official target. This is a deliberate strategy to erode the real value of both government debt and your personal savings. Your rising bills are the price you pay for their fiscal irresponsibility, all while your cash savings evaporate into thin air. In a world where cash is, losing its value and the economic future is uncertain, people instinctively search for a safe place to store their wealth. This is not a new phenomenon. For thousands of years during times of crisis, humanity has turned to one asset above all others: gold. The current surge in the price of gold is not a speculative bubble driven by greed. It is honestly a rational flight to safety driven by fear. Investors and even central banks around the world are looking at the mountain of debt, political chaos, the deliberate policy of currency devaluation, and they are making a logical choice. They are trading their paper money for a real, tangible asset that has preserved wealth for millennia. Gold's appeal lies in its fundamental properties. It cannot be printed into existence by a central bank. Its supply is finite and grows very slowly, only through the difficult and expensive process of mining. This makes it the ultimate anti-dollar. While the Federal Reserve can create trillions of dollars with just a few keystrokes, they cannot create a single ounce of gold. This is why gold holds its value over time. It's not that gold is going up, it's that the purchasing power of paper currencies is going down. The dollar, the euro, the yen. The rising gold price is simply a measure of how quickly our currencies are being debased. What is particularly interesting about the current gold market is who is buying. For a long time it was primarily central banks from countries like China, Russia that were accumulating gold, trying to diversify their reserves away from the US dollar. They saw the writing on the wall years ago. However, individual investors in the West were slow to catch on. Many were still selling their gold ETFs even as the price began to climb. That is now changing. Regular investors are finally waking up to the threat of inflation and are starting to move their money into real assets. Once you understand why you need to own gold, the next logical question is how to own it. For beginner investors, the options can seem confusing, but they generally fall into three main categories, each with its own set of advantages and disadvantages. The most traditional and direct way is to own physical gold. This means buying gold coins like American Eagles or Canadian maple leafs or gold bars, and storing them yourself in a secure location like a home safe or a private vault. The primary advantage of physical gold is that you hold it directly. It is a tangible asset that exists outside of the financial system with no counterparty risk. If the banks close or the stock market crashes, you still have your gold. By combining these different methods, you can build a robust gold position that provides both safety and the potential for significant growth in the uncertain years ahead. While gold is the undisputed king of monetary metals, it is not the only real asset that can protect your wealth from the ravages of inflation. A well-rounded strategy should include other commodities. Chief among these is silver. Often called poor man's gold, silver shares many of gold's monetary qualities. It has been used as money for thousands of years. It cannot be created out of thin air. Silver is also a critical industrial metal. About half of its demand comes from industrial uses: solar panels, electronics, electric vehicles. Another critical real asset is copper. It lacks gold or silver's monetary history, but copper is the backbone of the industrial economy. It's essential for electrical wiring in homes and complex machinery. The global transition to electric vehicles and renewable energy will push copper demand higher. An EV uses about 4 times the copper of a gasoline car. Wind and solar farms need massive amounts of copper. This electrification is creating a structural deficit, with demand outstripping supply for years. The supply side strengthens the metals case. The past decade saw severe underinvestment in new mining for gold, silver, copper. It can take 10 years or more to discover a deposit and bring a mine online. You can't flip a switch to create supply overnight. While the case for owning real assets like gold is compelling, it is crucial to approach this new economic landscape with a clear understanding of the risks involved. No investment is a guaranteed one-way ticket to riches. The same political instability that makes gold attractive also creates a world of uncertainty. A new government could suddenly impose a windfall tax on mining companies, wiping out their profits and crashing their stock prices. This is why diversification is not just a suggestion, it is your single most important defense. So what can an ordinary person do? Navigate this treacherous economic environment? The first and most important step is to educate yourself and accept the reality of the situation. You cannot protect yourself from a threat you refuse to see. Understand that the value of your cash savings is being intentionally eroded by government policy. The rising prices you see are not a temporary glitch. They are a feature of the new economic reality. Abandon the old mindset that a savings account is a safe place for your long-term wealth. In an inflationary world, holding too much cash is the riskiest financial decision you can make. The goal is no longer just to grow your money, but to protect its purchasing power from being destroyed. You can survive the coming turmoil and emerge with your financial security intact, but also a time when fortunes can be made and preserved by those who see the truth.